Welcome to the daily update, where I'll go over the action in the market for Tuesday, March 18th, and we'll see how things look for Wednesday, March 19th. Well, after at least last Friday was a solid up day, we did see a solid update on Monday in terms of volume. We saw mostly up volume. There's still a lot of technical damage that needs to be repaired. Well, then on Tuesday, we had a pullback. Some of our indicators are actually showing signs of improvement, but we had another down day. We're not seeing any improvements when it comes to growth versus value. This still suggests that the market is becoming more defensive, and we're still below a lot of long-term and even short-term overhead resistance. So let's go back and talk about what happened and then look at some charts. We had a lower open and we just immediately shot down right after the open. We declined below S1 at 56.36, and then we found support at S2 at 55.98. So pretty much figure the 5600 level. And then we just stayed there. We just chopped sideways. We were above S2 and we stayed above 5600 for the rest of the session. So really, there was no additional selling. There was no additional buying, really. We just chopped. So we were down 1.07% on, this is interesting, below average volume. What we've been seeing lately while we were coming down is above average volume. Then last Friday and Monday, we saw a bounce on below average volume. This is where it gets interesting because now we had another down day on below average volume. So you've got a lot of folks that they think certain things are going to happen, but there's a real tentative nature to the market right now. Plus, the Fed is going to be meeting on Wednesday, and so there might be some wait and see for that. But when we look at the short and intermediate term, we are still negative. We're mixed in the long term because we're below the 200-day simple moving average, and that's been that way for a while now. Interest rates were down a bit, and we didn't really get any economic reports that were that important that really drove the market overall. A lot of this has to do with geopolitical factors that are going on. You've got things going on in Yemen with the U.S. bombing the Houthis there, things going on in Israel, of course, all of the stuff going on within the U.S., and it's really producing a lot of jitters currently. Okay, so some comments. President Trump had a call with President Putin in Russia, and the markets really didn't respond to that all that much. Didn't drive it up, didn't drive it down. There was a statement that was read out and released saying that leaders agreed that the movement to peace will begin with an energy and infrastructure ceasefire, as well as technical negotiations on implementation of a maritime ceasefire in the Black Sea, full ceasefire and permanent peace. So there's some progress being made with that. We'll see if it actually leads to something. And then the mega caps didn't have a good day, and that's growth. And so when they don't do really well, the market tends to not do really well. We're back a little bit further above 20 now with the VIX. We were getting close after Monday. Well, we're at 21.7 now. That's still where we're more concerned because we see negative annualized returns when the VIX is above 20. On a short-term basis, not a real long list here, but we still have the short-term ADX chart, and then the stochastics just in the long term are looking extreme negative. The rate of change going back 20 periods, that's still extreme, and the slope oscillator, but it's starting to turn up. That's some of the improvement that we're seeing. And then the boom indicator, that's just suggesting that we're still far away from the 20 period moving average, which is what I use to measure the short-term trend. Intermediate term, we're also still far away from the 50 period moving average. That's the boom 50. The Sean trend meter slipped back down to extreme negative, and the TTM squeeze as well is still extreme negative. We continue to have a non-confirmed Hindenburg-Omen. We had the first signal that came out on March 3rd. Now we have 20 trading days, which will be March 31st, to see if we're going to get another spike in that. That would be confirmed at that point. We still don't have that yet. No changes to the overall scenario with the Fed. We'll see if that does change on Wednesday because they're not going to change rates, but They're going to have a lot to say. What are they going to do? What's the impact going to be on the market? We'll be paying attention to that to see what the fallout is. The dollar was down, interest rates were down. We're at 4.28% with the 10-year yield, where after Monday we were at 4.31%. We're still below that 25 level with sentiment. We've just been camped at this area now, and which is very strange. Usually we come down, it's a washout, some kind of climactic event in the market, and then we bounce up out of that. No, we're still coming in at 20, where after Monday we were at 22, and we're back to even with the 10-year to the 3-month yield curve. So that's been going uninverted, then dropping down and becoming inverted. Right now, it's back to even, where the yields are the same. As far as the trend, we're still negative there. The ADX is above the moving average, and we're above 20, so that's a confirmed trend. It's negative because the red line is above the green line, and because of the down day, the bias is negative in the last number of days. Even with the two big up days, I'm still keeping the momentum at negative. We need to get back above some of this overhead resistance, especially the 200-day moving average on the S&P. If we can't do that, that's really going to shift things more negative, and we remain more negative until that happens. If that happens. As far as the economic reports, housing starts came in at 1.501 million. That was more than the 1.385 million they had expected, and up from the 1.35 million we saw last time. Building permits, a little bit more than expected, 1.456 million. They expected 1.45 million. And last time it was 1.473 million. So a little bit of a decrease there. And I don't have charts for these other ones here. I'm just going to go through the numbers. Export prices were up 0.1%. Last time they were up 1.3%. If you take out agriculture, also up 0.1%. They were up 1.5% last time. Import prices up 0.4%, the same as last time. And then if you take out oil, up 0.3%. Last time they were up 0.1%. So a lot of this could be just pre-tariff maneuvering that's going on, that's making these numbers move around the way they are. But the market's already freaking out about these tariffs, and it's producing a real unsettled atmosphere. So it's not so much what we're getting from the reports that are coming out, it's just the overall climate. Then industrial production came out. It was actually quite a bit higher than expected. It came in up 0.7%. They thought it would come in up 0.2%. Last time it was up 0.3%. So that just means companies are producing more. They're being more efficient that way. Then capacity utilization, all the factories, everything that's being used. How much of that is actually at use? 80% is considered to be full capacity. Well, we're at 78.2 and we're up from the 77.7 that came out last time, and that's also what they expected to come in this time. So production is up and utilization is also up. That's pretty good for the economy. Here's the chart of housing starts and building permits. This is a 3-month average where the blue line, the starts are going up, and we're seeing the building permits actually coming down just a little bit. And then housing starts, looking at it this way, where we did increase from the previous reading. Then production and capacity. So industrial production, the blue line, it came down when we look at this on a year-over-year basis, but it's still above zero, and we're pretty much flat right now with capacity utilization. So the stronger numbers that we've seen, that's just more short term. This is looking at a year-over-year chart. Then here is capacity utilization above the 78% level. And notice how when we get up to the 80 level and even go above that a little bit, that's pretty much where we top out. But the fact that this is going up should be taken as positive for the economy. And then industrial production month over month, it did really increase from the previous reading, but it's down from the reading that we saw even before that. All right, then looking at every week, we check out the overbought, oversold composite. We are now getting down into oversold territory, coming in at 23.1. So, yeah, and we're seeing that on a lot of our charts. We're seeing that as far as sentiment. Things are negative, but we're not bouncing out of this negativity. We're just kind of coming down, getting negative, and then just staying negative as far as how people are feeling right now when it comes to the stock market and even in culture right now because there's so many changes going on. Then I tried to blow up this other chart again. This came out before Tuesday's decline. A buying thrust the past 2 days could be quite bullish. And then it projects it out when we've seen these, when we have two 90% advancing issues back to back. And that's what we saw on Friday and Monday. So looking out, we're up 63.6% of the time a month later, 3 months later, and then 6 months and 12 months, we get up over to almost 91% that were higher. So a lot of times this big upthrust, especially when we've been coming down, and we came down fast. So there is some bouncing going on. We're just not really seeing it played out yet. But if you look out into the future, this often tends to be positive. And then I usually go over this in the intermarket analysis video over the weekend, but this comes out periodically. This is the valuation comparing the US, which is getting closer to that 20 level, with the PE ratio. We do use a 10, 15, 20 scale. When we're above 20, that means we're expensive, and we're still above 20 now, but we have been getting much higher readings. And then this just compares it to the rest of the world and what their PE ratios are currently. Goldman Sachs Financial Conditions Index. So it's showing here that we're actually going up a little bit. That's a little bit more positive. But if you take out equities, because they've been getting hammered, okay, this has actually been coming down. And gold is still a long way from its inflation adjusted peak. I don't know if I'm misreading this chart or not, but when the blue line, which is the spot price, that means the cash price right now, where futures, that's looking, okay, what's the price going to be at some point in the future? And then the inflation adjusted price, well, to me, it looks like the blue line's above the white line. So I don't see where it's being overvalued right now. I take the opposite of what this headline is saying. Maybe I'm just looking at this chart incorrectly. Then, since we had retail sales come out on Monday, we're still kind of flatlining here, which we have to be a little bit concerned about because it's not that we see a real decline necessarily in retail sales before we go into a recession. We see more of a flattening out. And that's kind of what's happening. There's been some up and down here, but we've been flat for quite a while, but yet have not gone into a recession, at least yet. And then a falling appetite for protection. And I actually included the screenshot here. It says signs of stability are emerging in the S&P 500 after a sharp correction. Now, what if we're just getting going with this correction? Because what this is saying is that people are not hedging right now. They think we're done with this 10% drop and we're going to go up from here. What if we continue to fall? Now, that could really escalate things to the downside. So it says traders abandon bets on further significant declines, reflecting growing confidence in the market. Well, tell that to Tuesday. I mean, we were down over 1%, but if we do start to break through support again and start to really turn and go down even more than what we went on Tuesday, because we haven't gone down to a new low, at least yet. This seems to be what we saw on Tuesday was more of just a give back from what we saw going up in Friday and Monday session. But if we do start heading lower, they're not really hedged right now. So that could produce things. If we go down, that means that things could really accelerate. Now, they could also be right about this, and maybe they're taking off their protection at this point because they're pretty confident that we're going to go up. At least that's what they're trying to tell us here in this chart. And then the market has sharply downgraded expectations for economic growth. We're seeing this indexed return of cyclicals. They cycle with the economy. When the economy is doing better, those areas of the stock market do better. And then the defensives, they've been really outperforming lately. That's why we're seeing this ratio going down, like staples, toilet paper, toothpaste, things like that. So, and this is kind of what we know already, is that we've been seeing earnings projections coming down for stocks. We're seeing more of the economic reports that have been coming out have been weaker than expected to a degree. Employment's holding up pretty good. But as far as the other areas of the economy, we are seeing things weaken right now. And then where are things as far as the mega caps and tech positioning? We're actually below the dashed line because people are starting to sell those areas since they've been underperforming so far in 2025. And then consolidated equity positioning is also going down right now. It's below zero. Then this was an interesting chart. It says company executives rush to buy stocks amid sell-off. That could actually be positive. These are legal insiders that come in and buy shares of their own company. And if they see where the price of their stock for their company is taking a hit, they're like, well, we've got a pretty good thing going on here. We're making lots of money. We've got future prospects look pretty good. I'm going to go in right now and buy some of this company that I work for. So this could end up being positive as for the market. All right, then the intraday chart here. We had a little bit of a gap down. It wasn't that much, but then we just saw immediate selling right after the open. We just came down, we dropped below S1, and then we chopped our way down to S2. This is right about at the 5,700 level, excuse me, 5,600 level. I think I might have said that incorrectly earlier, but this held up for right now. Now it's a round number, but the more the price comes and hangs out at these levels, the more technical, from a technical analysis perspective, that becomes. But then we just chopped sideways. We didn't really see any buying into weakness, or when we popped up, we just kind of came right back down and just drifted sideways for the rest of the day. This could be some let's wait and see what the Fed's going to say kind of a thing, even though it's a 98% chance they're not going to do anything with interest rates. Here's the intraday chart, also pretty quiet in the initial overnight session. We were drifting down as far as the futures. They had been a little bit more positive, and then we just, but not much. And then we just saw most of the loss come right at the open, and then we just drifted sideways after that. This is still suggesting the market is remaining more defensive, where the red line is above the blue line. Red line is value, blue line is growth. We want the blue line to be above the red line if we're more positive. And we're seeing this dropping back now. We saw a few days of improvement, but the big up days that we saw, we didn't see much of a change in the growth to value ratio for the S&P. This also suggests the market is still remaining more defensive. And end of day growth down 1.7%. Value was down, but a lot less. And it was down more for the mid caps and down more for the small caps. So we're just kind of chopping around below our 200-day moving average with the small cap growth to value ratio. Same thing with the mid caps and same thing with the S&P. So no improvements there, but no real weakening either. We're just kind of chopping around in a range currently. We did drop a little bit down here with the growth to value ratio with these two ETFs, where we're still below the rainbow and declining. And we're still hanging out around the 200-day moving average with the discretionary to staples ratio as well. So no improvements in these areas, but no major damage was done either. We're just kind of back to where we were. As far as the trend, we are rolling over a bit with the ADX, but we're still negative because we're above the moving average and the red line is above the green line. Short term, we're coming down. We could be crossing here. This could suggest a weakening trend. Doesn't necessarily mean a change in trend. This tries to pick up that when we were really coming down, we saw that being a strong trend. If we cross below the moving average, maybe we're going to be in for some sideways action for a while. That that's just speculation. All right, and we're below average again. Friday, Monday, and Tuesday we're all below average with volume, and I have another newer chart that shows that when we're red here, that just shows that we were below average. When we're green, that shows that we're below or above average with volume. Sentiment still getting a very high reading with the Ulcer Index. That means fear is high here. And ticking back up above 20 with the VIX, both with the line chart and the bar chart. But the VIX of the VIX is still below its moving averages. So that was really coming down as the VIX was coming down and showing that the VIX is becoming a little less volatile. In fact, we're actually rolling over as far as momentum. The MACD is actually crossed below the moving average, and now we see where the momentum is going down for the VIX. And we declined with this fear gauge, and we ticked up just a little bit with this other fear gauge. A little bit of a discrepancy there. We're keeping an eye on this, the spread between risky and not as risky bonds, and that actually improved just a little bit. We're coming back up where we had been really falling. That's more fearful. When this is going back up, that means there's a little bit of the fear is decreasing. And not much of a change with the equity put call ratio on the daily chart. We're still kind of flat right now with the 5-day chart, and we continue to decline with the 10-day chart, which tends to be more positive, but we're not seeing an awful lot of conviction here. And we're still falling overall with the risk on versus risk off ratio. That means the market's getting more defensive. And we did bounce back up over the Friday and Monday's advances, but we declined in Tuesday's session. But we're seeing fear really dropping off here with volatility risk premium. It's below the band and declining. Still holding up as far as the advanced decline line based on price and volume above the moving averages. And we're actually a little bit positive here with our advanced decliners over a 10-day period. We crossed back above zero and not really much of a change here. We're trying to turn up with our new highs, new lows with the 5-day, but we're still headed down with the 10-day. We're still above zero in the short term with the advanced decline ratio. We're still below zero with the more intermediate term red line advanced decline ratio. We're coming down, but still above the moving average with accumulation distribution. So that's still hanging on and being positive with smart money indicator number one. But we're still negative with Chaikin money flow, smart money indicator number two. We're back to being negative again with the red line going down. And now we're turning back down with the Chaikin oscillator. But you can see how choppy this is. We're not really seeing any conviction, especially when we got into the latter part of February. There was a lot of conviction here, but the end of February and so far through the middle of March, it's just been chopping around a lot. The smart money number three indicator is also negative. It dropped enough to go below its moving average. And we're negative here with the vortex. The red line is above the green line. And we're still below 50 with those stocks in the S&P above their 20 period moving averages. That's negative. And we tick down a little bit with the 50 period moving average study, the 100 period moving average study, and the 200 period moving average study. And all of these are below 50, so they're more negative. We're still slightly above the advanced decline line with this other moving average here for the S&P, but we're still below the moving average with the NYSE common stock, mid caps, and small caps. And we're still below the 200-day moving average, and we're dropping even more below the moving average here as far as volume. And the rate of change going back 20 periods, we wore off this extreme negative reading. Well, now we're back down here again. You can look at other times when we had this reading. This was the end of the world day last summer, and then we were able to bounce up out of that. Actually, this occurred right around that time. So we'll see if this ends up producing some kind of a positive bounce. Little bit of a tick down with the 20, 50, and 200 period moving averages, but they're right around their midpoints here. We're still far away from the 20 and 50 period moving averages as measured by the boom indicator. We're still below these red lines. And we're a little above the midpoint with the Stochk RSI, but it's not giving any kind of an extreme reading. And we're turning back down and a little more negative with the Williams percent R, and still in the lower end of the range with the CCI 14 and the CCI 20. But none of these are extreme right now. We're not extreme in the short term or intermediate short term with the stochastics. We're still trying to turn up here with the long short term stochastic. The force index is still negative. The condition of the short term trend is still not, oh, this is the intermediate term trend. We're still below these two lines. I'll get the short term trend later. I got these charts mixed up. And we're back down into the -2 channel with our standard deviations chart. Then we're still below zero with the balance of power after it had been improving. We're still more negative, but a lighter shade of purple with the no-go system. Still closer to the lowest low value for the S&P. TTM squeeze, it is improving. We're the lighter shade of red, but we're still below this black line. We're getting an extreme negative reading, and this is really extreme, but it's trying to show signs of improvement. This is the short-term trend here. We're right in between the green line and the blue line here, showing some signs of improvement, but until we get above these lines and stay above them and see the lines turn back up, we're still showing more of a mixed to negative picture. We're still below all the moving averages here that are plotted. And these shorter term moving averages are really coming down and could be starting to cross below the 200-day moving average if things don't improve. We are hitting overhead resistance. This had been support. This is going back to the low set a year ago, this light blue line. We came right about up to that level, and now we've been coming down from it. And we're still going pretty fast, but not as fast when we look at standard deviation. And we're still negative with the ease of movement. We're still positive with the S&P McClellan oscillator, even though it declined. It's still above zero. So we're still going up with the summation index based on price and volume. And we declined with the NYSE McClellan oscillator, but still above zero. So we're starting to turn up with the summation index for the NYSE based on price and volume. Slight improvements there. We're still negative since we're below zero with the Arun. This measures buyers versus sellers. When we're above zero, that means the buyers are winning. When we're below zero, that means the sellers are winning, and the sellers are winning right now. We're still seeing things look okay here with the Swindler Trading Oscillator. We're going up based on price and crossing above zero. We already crossed above zero based on volume, but it's continuing to advance. And we're still neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR since the dots are underneath. Momentum is improving a little bit, but still negative. The PMO is going down and it's below this green line, which is extreme. We're trying to turn up, but still negative, both based on price and volume. And we're just about at the midpoint with the PMOs that are rising. Those are PMOs inside of the S&P 500. Still seeing a little bit of an improvement with the buy signals, and we're getting flat now with the PMOs above zero. And we're trying to turn up with the slope oscillator. I mean, we get concerned when we go below this red line. That means it's extreme, but look how far below the red line we are. But this could be showing some signs of improving in the short term. Trying to turn up, but still below the moving average with the MACD. So the short term is showing a little bit of improvement. It likes what it saw last Friday and Monday. We're improving in the intermediate term, but still negative, where we're still headed lower with our longer term oscillators. And the copy curve, trying to turn up, but still below the red line. Longer term, we had become deeply negative here with this, but it's still negative. And we're back to looking extreme negative with the Sean trend meter. We're in the pink area. We're below 50 with the money flow, and we came right up to 50 with the ultimate oscillator, and now we back down. So we are negative there. We're still below the moving average with on-balance volume. That's negative. And we're still below 50 with the RSI 14 and the RSI 9. We did see an improvement here. The bullish percent index is still positive. There was enough of a buy, at least based on point and figure charts in the S&P, to make this go up a little bit. So this is still positive. And we're going back up a little bit with the NYSE bullish percent index, but we ticked down slightly with the NASDAQ 100 bullish percent index. Still waiting to see if we're going to get the third part of a signal here with the mass index, which would suggest a reversal. And no signal here with the praying bottom fisher. It has to cross above the red line to generate a buy signal. All right, and then I extended this out a little bit. We came back up to the 61.8% retracement level after the 50% retracement level held. Now we're having a hard time getting above this. Are we going to break down below the 50% level again, or are we going to be able to break above the 61.8% retracement level? And this is measured from the April 2024 low. That was a pretty significant low, a recent low. And then the all-time high set back in February, which seems like a distant memory now. And we're still holding above support above this pivot point with the weekly chart of the S&P. That's rather significant. So this support is holding. And we're more of a doji looking candle here with the Heiken Ashi. It means indecisiveness. And we're positive but pointing down with the Kegi chart. We're still negative with the Renko chart, and we're negative with the three-line break chart. So getting a bit of a mixed picture there. Still ticking down a little bit with the 150 and 200 period moving average study after we had been seeing signs of improvements. All right, this doesn't seem to change. We're still negative in the short and intermediate term with all the different stock indexes, positive in the long term. And bonds are still positive in the short and intermediate term. We're back to negative with commodities in the short term. The dollar is still in a downtrend in the short and intermediate term. And we had two areas, defensive areas, that were positive: energy and healthcare. All of the other sectors ended up being negative, with discretionary, a growth area, communication, a growth area, and tech, a growth area. These were the ones that were leading things lower. And these are growth areas. and they're not growing right now. They're actually retreating. Okay, nothing but red here. Valentine's Day for you, with the Nasdaq crossing below all these different levels from 17.8 all the way down to 17.5, and then with the S&P crossing below 5,600, but it was able to get back above that. We're still below the 200-day moving average with the Dow. That should be reclaimed. It was the first, excuse me, it was the last major index to lose the 200-day moving average. We're going to see if that can be the first to get it back. And we're neutral with the Elder's Impulse system for the diamonds. Still negative here with the NASDAQ and NASDAQ 100, but both indexes are holding above these S2 support levels. We're neutral with the Elder's Impulse system for the Qs. Momentum is improving, but still negative for the NASDAQ 100. We bounced up off of this S2 level for the small caps, but you can see we're generating a death cross now. This is a longer term downtrend, but we've seen these before. And about the time we see a cross is when we see a counter trend move. Sometimes that happens with Bitcoin a lot too, and other things as well. Also, not quite at a death cross here with the Russell 2000 small caps, showing a little bit of a sign of improvement here with momentum, but we're still below 50 with the RSI. We're neutral with the small caps with the Elder's Impulse system. Mid caps, not quite at a death cross yet, but headed in that direction and still holding up above this S2 support level. Neutral with the Elder's Impulse system. And we were virtually unchanged to down slightly with the financial sector. We're still below the 50-day moving average, but above the 200-day moving average. And we're still having a hard time with the bank ETF getting back above its 200-day moving average. The Wilshire is still below its 200-day moving average, as is the total U.S. stock ETF. It's like we came right up to the 200-day moving average and bounced back down. That's what we're watching for. If we get to that point with the S&P, that that's going to be very telling. If we get up to that point, if we even get there, and we hit that and turn and come back down, or if we break through it and are able to close above it, that's going to be very telling as far as are we going to go back to being negative or positive. FANG index fell down back below its 200-day moving average. It's been kind of skating along it here for the last number of sessions. Apple was down 0.61% below its 200-day moving average and getting kind of close to a death cross here. Amazon also below its 200-day moving average, down 1.5%. In a downtrend already with Microsoft down 1.33%. Google below its 200-day moving average, down 2.2%. And coming down to its 200-day moving average is Meta. And Tesla is well below its 200-day moving average, down 4.33%, excuse me, 5.33%. And we're starting to see a death cross form here with Nvidia, and it's well below its 200-day moving average. Netflix looking a little bit better these days. It was down 2.11%, dropping a little bit below its 50-day moving average. And we're still seeing a strengthening in the short term of US to world stocks, where longer term, we're seeing that correlation actually get weaker. Oil is not really reacting all that much with all the geopolitical things going on. It's actually dropped almost 1%. And the dollar, it's up in the overnight session here, but we're still down below its 200-day moving average. And we're down slightly here with the 10-year yield, but we've been chopping sideways recently, and we were up a little bit here with the 10-year based on price, also chopping a lot these days. We're back to zero here with the yield curve between the 10 to the 2-year and the 3-month yield curves. They're even right now. Really not seeing any strength here with our growth to value ratios with the Qs to S&P, discretionary to S&P, and large cap growth to large cap value. They're all below declining moving averages. And so we're declining with the large caps, mid caps, and small caps. And this is dropping down a little bit as the S&P has been underperforming utilities, but this has been very choppy lately and not really showing an awful lot of conviction. So what's the outlook for Wednesday? Not much of a change here. We're still negative in the short and intermediate term, below the 200-day moving average. And so far, the longer term support is holding. We're going to get the MBA Mortgage Applications Index. We get that every week, but the big one is going to be at 2 p.m. Eastern when the Fed makes their announcement. And then on anything geopolitical, talks between the US and Russia concerning the Russia-Ukraine war, escalations that could occur in Yemen or in Israel, and any blowups that could happen within the US. And then on Thursday, we'll get jobless claims. And then I like to keep an eye on the LEI, the leading economic index, just to see what is it forecasting looking forward here. And we won't have any reports on the first day of spring. I think that's the first day of spring this year. And here's another look at the economic reports for Wednesday and then what will be happening on Thursday. Seasonality, we're positive though for March 19th, positive across the board with all three indexes. We are dealing with options expiration week, and we tend to be up more than down during that week. And we do have some positive seasonality here, at least for another day or so. But then we see, at least in a post-election year, the green dash line, then we see some weakness after that before we see a bounce up from there. And we are in the second half of March, which tends to do okay. And then this shows that we just kind of trail along and then break out later in the spring. All right, so we're still getting a mixed picture with our smart money indicators where the accumulation distribution is positive, but the Chaikin money flow and oscillators are negative. And the NASDAQ 100 and NYSE bullish percent indexes, they're improving, but they're still negative. And we're negative with the momentum, even though we're showing signs of improvement there. The Copic curve is trying to improve, but it's negative. And then I'm not showing this chart because we get so few signals. The long-term special K is negative. And so that'll just remain on the list until we change. The moving average studies, all of them are still below 50. So that's negative. The ease of movement, money flow, and ultimate oscillator are negative. The vortex continues to be negative, and the momentum for the NASDAQ 100 is trying to improve, but still negative. On the positive side, we still have longer term uptrends with growth of value, but it's more short term. We're just not seeing it outperforming right now. And then the equity put call ratios, actually this should be they should be going down there, but we're just not getting a lot of insight from those charts right now. And the S&P and NYSE McClellan oscillators, even though they declined, they're still above zero. That's making the summation indexes go up. Parabolic SAR is positive. The bullish percent index for the S&P is positive. The financial sector is positive, but we're watching this bank ETF that just can't seem to get back above its 200-day moving average. And the Swindler trading oscillator is positive. So our conclusion, we're negative in the short and intermediate term, mixed in the long term, but still considered positive. In the short term, we're slightly oversold. We worked off some of that. And then when we were bouncing up and then we're drifting back down and the list is becoming a little bit longer now. And we're still positive in the long term, but we're below the 200-day simple moving average. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.